Hey everyone, me Kevin here. I just want to talk about a mistake that I made on my portfolio and how I'm fixing it and what I learned from it. And it's also something that you might specifically learn from right now because it's happening right now. I don't like to make videos looking into the past, which is difficult because when you make videos about the past, like you can guarantee your video, right? Like the success of the video. But I kind of like to try to make videos where I'm trying to understand what's going to happen in the future, even if that means I'm not always right. I'm okay with that as long as I keep making educated opinions. And no, I'm not wearing a members only jacket, as some of you say in the comments, on purpose. It's just cold in here. It's like 65 degrees in here. But anyway, this video, it's not to brag. I want to show you that this video is very personal to me because it has to do with money that I made and a mistake that I made. And again, it's something that you could learn from. I made my money grinding away in real estate when I was 19 years old. I had just $9,000 in the bank. So this is not to brag. I want to get into the mistake though, but in order to do that, it's helpful for you to understand a little bit about my portfolio. So here's the scoop. This is my Robinhood right now. I've got about 921K invested in Robinhood and about 125 in margin. So keep that in mind for just a moment. And then I do want to show you my M1 Finance as well. So I'm going to pull that up, and there's a mistake that I made in both of these portfolios. And I'm showing you these because I don't want you to think like the title's clickbait or whatever. No, it actually is here. So this is the M1 Finance portfolio, and there is, obviously it's heavy on Tesla, Amazon, Etsy, Apple, but, then there's some margin here as well. But anyway, the reason I'm showing this to you is because I want to open up to you about this mistake. And it's very personal, so I figured, hey, let's just put the cards on the table, then we can actually talk educated about it. So if the numbers aren't relatable, I get it, just scale it to whatever numbers that you've got. Because remember, I started with $9,000 at 19 years old. And so while this video is personal, it is also sponsored by Life Insurance and Webull. Make sure to get your 2 free stocks with Webull when you deposit just $100 with the stock trading platform Webull. I do use Webull, by the way, as well. I know sometimes people are like, Kevin, you use M1 Finance and Robinhood. Well, where's the Webull? This is my Webull. I do have, oops, sorry, wrong button. This is the Webull. I do have Webull as well. I don't have as much there, but I actually found a trick to finally get money to them a little bit faster. Oh, sorry for the picture-in-picture there, but whatever. Okay, let's now get into the problem. First, I want to start with this. I'm a notorious buy and holder. I buy stocks like Tesla, Redfin, Amazon, Etsy, and Apple without the intentions of selling them. At least not for the next 10 years. I'd like to say forever, but I do realize that things change, so there may come a time when it makes sense to change. But my strategy is very long-term based. So here's for those of you who are traders who leave me comments all the time like, Kevin, but you bought Tesla when the RSI was really high. Why would you buy when the relative strength index is so high? You should have waited, you should have timed better. Because the relative strength index might be really high when Tesla's at 700 relative to, I don't know, the last 3 months, but now it's at like 1,400, right? So as a long-term trader, I'm not always looking at these individual like short-term technicals. And that's not to shade traders, I just want to clarify that. And now I'm gonna get to the mistake now. But don't understand the mistake, you have to know a little bit more background. In March and April, I started buying Delta Airlines, the Simon Property Group, Carnival, the Cheesecake Factory, Dave & Buster's, and companies like this, mostly Carnival, Delta, and the Simon Property Group, right? My plan was I would stop buying real estate for 2 months. I would buy these recovery stocks with about 10 to 15% of my portfolio, along with my favorites for the rest. And once these stocks rebounded in a V shape that we were going to have, I would sell and buy more real estate. Well, here's where the big mistake came in. In May and early June, I did switch to buying real estate. This was going according to plan. Stocks were rising, so I was moving over to real estate where I could guarantee buying properties below market value. I just closed a deal for $559,000, and I'm in escrow to purchase about $2 million more worth of real estate right now, including a 4-unit apartment building, which I can't wait to share with all of you. Then on June 7th, I bought Dave & Buster's because, well, come on. The recession was canceled. In fact, I'll never forget that day. The recession was over. We were on the path to being just like all the other countries in the world. China, Canada, Germany, all these other countries, Italy. What's happening over there? Cases are gone, the curve got flattened, the virus went away, recession's canceled, COVID's over, kids are going back to school, the reopening's going great, and everything is awesome. Simon Property Group hit $95, Delta hit $35, Carnival hit $34, and the only stock left that hadn't really rebounded yet was the stock I bought the day before. That was Dave & Buster's, which I bought on June 7th. That is, had the recovery continued, there would be no reason why Dave & Buster's would not be able to strongly recover. And Dave & Buster's was poised for not even potentially only a doubling, potentially a 2.5xing. And then when it went down to $15, it shaved $3 off the price. It was a potential 3xer of a stock. And everything was going great. Of course, this is where my fatal mistake came in. In March and April, I told myself I would sell the recovery stocks as soon as they crossed certain thresholds. As soon as they made certain profits in that V-shaped recovery, I would sell. Well, guess what happened on June 8th? When all these stocks were at highs and the recession was canceled. I didn't sell. I didn't sell because I'm such a long-term investor whose sell button is broken that I didn't sell the stocks that I bought with the intention of selling. Look, I don't plan to hold Tesla and Apple and Amazon and Etsy and Redfin blindly, for 10, 30 years or whatever, 10 to 30 years. I'm not gonna kid myself and blindly hold a stock. But I do believe that I have the likelihood of holding these stocks for the next 10 plus years. There shouldn't be a reason for me to sell and pay taxes on those. I like that. I like those stocks and I plan to keep them long term. But I went into these recovery stocks, right? The travel, the airlines, the retail and all that, with the plan to swing trade them. I was planning to buy them on sale and then sell them high. Yet when it came time to sell them high, my long-term investor mindset was like, we don't sell. What are you doing? And this was also compounded with the fact that, come on, the recession was canceled. Heck, everybody was euphoric at the beginning of June. Or, well, so we thought. And this is where the big mistake came in. Had I just set automatic sell triggers to automatically sell these stocks at my targets, which would have been like $80 for the Simon Property Group. Delta I would have sold at 30. Carnival, I don't know what my target was for that. It doesn't really matter. They would have had more room to run. Like they would have run up past those targets, but I would have taken more profit than I was left with waiting. Because certainly what happened after we waited? Well, that 10 to 15% of my portfolio got spanked a bit. In fact, the companies that were able to survive the 30 days to slow the spread, and I estimated that it would be 30 days to slow the spread and 60 days to mop up. That's kind of what I've been calling it, really 90 days to survive. I figured, come on, Delta, Carnival, the cruise lines, the restaurants, they're not gonna go bankrupt with a 90-day issue, right? Like we're gonna get spanked. It's gonna be like a hurricane. That's how I saw it. I grew up in South Florida. Hurricanes, you batten down the hatches, you take off work for a week, you batten down the hatches, you put up the boards, you help your neighbors who can't figure out how to get the darn boards up, you show off the cool shutter system that you got, then you go inside, crazy storm happens, you poke your head out a little bit during the storm and you're like, oh, pull the door back shut, and it's like crazy out there, you're not going out there. And as soon as the storm passes, you go out there and you look and go, wow, look at all these messed up cars and the shingles all over the floors and the tree all down and stuff. And guess what you do? You start cleaning up. That was what was supposed to happen with the pandemic. Now, I'm sure I'm gonna get like a million comments who are like, Kevin, that you should have known the second wave. I get it. Look, anybody can look in the mirror. Anybody can look at hindsight and go, should have done this. Whatever. That's why I showed you my portfolio at the beginning, because I'm dealing with my real money, and looking forward is hard. Looking backwards is very easy. It's really easy to Monday morning quarterback. So, what do we do now? Well, it sucks. This sucks because this 10 to 15% of my portfolio has been hit very hard now. My favorites, like Simon Property Group, which I give probably the least chance of going bankrupt, they're all down, like hardcore today. The Cheesecake Factory probably has more survivability, and like Darden and Olive Garden and things like that probably have more survivability than Dave & Buster's in a second shutdown because they can, do to-go orders. But still, all of these companies are getting saturated by debt, and what was 90 days to slow the spread, 30 days to slow the spread and 60 days to mop up could now potentially be a year-long problem. Now, the crazy thing is, as soon as a treatment comes out, not necessarily a vaccine, like a treatment that prevents avoidable deaths, and all of a sudden, like, you don't die from COVID anymore. All of a sudden you can survive and have a short, like, you're sick for 5 days and then you're good again. Well, as soon as that comes out, all of these stocks, Dave & Buster's has the potential of doubling to tripling. Cheesecake has the potential of doubling. Delta and Carnival, they're all gonna go up, 50% or whatever. It's all gonna happen very fast. We saw it happen once before. Simon's gonna probably double at this point in value since it got beat down again so badly. But what's happening right now? Right now, because there is a very real bankruptcy risk for some of these companies, Brooks Brothers just went bankrupt. Bed Bath & Beyond's probably going to soon. I mean, they just closed like 200 stores. What's happening? People are flooding into safety stocks. This is why valuations look so ridiculous. People are going nuts over Amazon, Etsy, Tesla, and anything that people see as a potential safety stock because they don't want to sit in cash because cash isn't making you any money right now, and they don't want to sit in bonds because bond yields are garbage. And so, what was my big mistake out of all of this? And what's the lesson that we can learn? Even though, that part of my portfolio is only 10 to 15%, and I can say if I net out everything with my recovery place, I am up money. Maybe like $10,000, which is not much for like 10 to 15%, but I'm not down, which is great, netting everything out. But it still sucks, right? So what do we do now, and what was my mistake? Well, my mistake, let me make that very clear. My mistake was not writing down my plan. My plan should have been written down. It should have been sticky noted up over here. I should have written down, these are my swing trades. I will sell these as soon as they hit this target, and then I will laugh my way to the bank. If the stock goes up more, I will still go laughing my way to the bank. That is what I should have done. Option B would have been to set automatic sell triggers, right? That is the big lesson. I should have done that. I did not do that. I played swing stocks that I would have never bought as a long-term holder, but I played them because I wanted the gains. I had the gains and they left because I didn't write down my plan and set automatic triggers. Now, what do we do now, like going forward? Here's the game plan going forward. You've got two things kind of going on right now, okay? This right here, we're gonna call this the vaccine and the cure. One of those would probably be very, very good for the recovery stocks and help us prevent bankruptcies. This right here is bankruptcy. Every single, let's angle it like that so it looks a little better there. Every single day that goes by, bankruptcy is doing this. It's creeping up like this. Every single day, the bankruptcy risk is going up. We have no idea how close the vaccine is. Is the vaccine here? Is it way out of frame? Is it, somewhere in the middle? We have no idea. All we know with certainty is that every day, the bankruptcy risk at these companies goes up. Every single day. That's why these stocks keep getting beat down. Because every single day, the stock market's going, bankruptcy risk is getting worse. More debt, more payments going out. At some point, these companies just have to look and go, like, who's gonna blame these companies for going bankrupt? At some point, people just have to, like, the CEOs of these companies just have to look and go, let's just pay ourselves a big fat $1 million salary, screw the stock, go BK on the sucker, and let's get the heck out of here and start over. Because we would be crippled once this pandemic is over to try to pay back all of these debts. It would almost be stupid to try to pay back all of these debts because we just won't be profitable for 5 years. It doesn't make sense not to file Chapter 11 bankruptcy reorganization. This is not like a Toys R Us bankruptcy. This is literally just a type of bankruptcy that's like, ha, shareholders, bye. All right, yo, I owe you money? Let's talk, because we're BK. That's literally what we're talking about here. So it's a big issue. So keep this in mind. Every day this is going up. Now, again, as soon as we hit ding cure, ding vaccine, boom, these stocks are gonna like, it's gonna be amazing. It's gonna be beautiful. It's gonna be huge. It's gonna be like a rocket ship. It's gonna be so nice. We're gonna have the biggest gains we have seen ever. Yeah, sorry. But what do we actually do going forward now, right? Well, going forward now, and this is what I've been doing. I started doing this about 2 weeks ago, which was probably about 2 weeks too late. Oh well. I started doing this about 2 weeks ago. I did substantially trim down my positions in Dave & Buster's and Simon Property Group. And I've been talking about that. You go through all the videos that I've done or in the course, I've been regularly talking about that. I'm not completely out. I still have a sizable portion of money in the recovery stocks, but it's a small percentage of my portfolio. Probably somewhere around 5%, if that. It might even be a little bit less. I have to crunch numbers again. But it's low. And it's because of this dirty BK coming up. And again, I would love to be in these guys long term because I think they have a real big bounce potential. I know they have a big bounce potential. But again, the BK risk is very, very severe. And right now, we're in a state where you really have to evaluate your appetite for risk. How heavily do you want to be exposed to the recovery sector? My recommendation is stay under 15% of your portfolio and keep the other 85% in stuff that you're not going to sleep at night thinking, oh my gosh, that thing is potentially going to go BK. That's bad. So hopefully you learned something from this. You know a little bit more about me, my personality, how I deal with these things. This is why I like real estate. You buy below market value. It doesn't matter if the value fluctuates a little bit. I'm buying below market value. Anyway, there you have my rant on what the heck this mistake was. Hopefully you learned something. I really appreciate you watching. And folks, we will see you again in the next video.